Hi, everyone. This is Maheen, and welcome to the Canadian SME Small Business Podcast. Today, we're looking at the front lines of the 2026 trade war. Now, for Canadian small businesses, tariffs is no longer just a headline, they are a direct hit to the bottom line, forcing owners to choose between slashing margins or passing costs onto a tapped out consumer. Joining us to discuss this very topic is David Jones, the founder and CEO of Merchant Growth. Since 2009, David has been a leader in digital financing, helping over 10,000 Canadian businesses access more than 800 million in funding. He's here today to discuss their recent trade war survey and how entrepreneurs can navigate this era of extreme trade uncertainty. So, without a further ado, let's dive in and welcome David. David, it's a pleasure to have you on the show with us. Thank you for joining. How are you?
Yeah, fantastic. Thanks so much for having me.
Very pleased to have you with us. Now, let's open a discussion, David, by understanding the trade war reality. I mentioned in my intro as well, we'll be covering lots, including the survey. Your 2026 trade war survey, it shows 41% of businesses, they have seen profit margins decline over the past year due to additional tariff costs. Tell us, at what point do rising tariff costs begin forcing businesses to shut down rather than just shrinking margins?
That's a great question. And it depends on the business. We finance thousands of small businesses. That's what we do at Merchant Growth. Every time we do, we get a financial picture on the business that's seeking credit. And we often see that customer over many years and see trends evolve over time. And then the one you just mentioned that we're talking about here today. And what we find with small businesses is that one, many of them are operating without a huge financial buffer. They're generally underbanked relative to bigger businesses. That's why Merchant Growth's in the business of helping them with financing. But the result is there's not a lot of financial margin of safety, if you will, to absorb shocks, to absorb changes. And so that leaves small businesses in a stressful position. And as far as when is that tipping point of, this is no longer viable, and as a small business owner, it's the responsible thing is to shut down. That depends on the cost structure of each business. Some have more fixed costs, some more variable costs. Of course, the ones with the most fixed costs are going to be the ones that are more challenged to stay viable in the face of rising inputs if they can't pass those cost increases onto their customers. And 41%, that's a big number. So, almost half of the small businesses we surveyed are seeing declining margins as a result of this situation. And it's important that we all understand that as consumers and businesses that serve small businesses, to really go out and support our local small business, because I think we all want to live in a world with vibrant small businesses and communities with a whole bunch of different entrepreneurial companies doing different things for them, as opposed to just relying on, huge conglomerates and companies, et cetera. So let's keep rooting for those small business owners for sure.
Absolutely. When thousands of dollars are lost just to keep the goods moving, the window of for survival becomes dangerously small. So thank you for highlighting, the survey insights, David. Now let's explore how rising costs are forcing businesses to reconsider their pricing strategies. David, have Canadian small businesses reached a pricing ceiling where they can no longer absorb trade costs?
Again, that depends on, the economists call it price elasticity of demand. So if you raise prices, to what extent does that hurt your volumes? To your point earlier, in the kind of intro to this podcast, consumers are also feeling pretty pinched these days. It's not, a super robust economy. We're not in a big recession, but we're not in a fast growing economy either. It's pretty flat and not easy out there. And so, what we found is that a lot of businesses plan to try to increase those prices over the next 6 months. So 43% of the businesses we surveyed are planning to raise prices in the next 6 months. In the past 12 months, about half the businesses we surveyed have not yet added any costs to their customers. So, they've been shy to do so up until this point, but it's kind of, coming to the point where they really need to in order to stay viable. So we're going to likely see more price increases. And of course, that means more inflation potentially in the broader economy as we look forward.
hmm When reaching the limit of price absorption, it means that the real world impact of trade wars is finally hitting the average Canadian's wallet. And it's not looking like a good news at all. And that is why we want to discuss why many Canadian businesses are scaling back from the US market. David, is the pullback from the US market a temporary survival move or a long term shift away from global trade?
I think that it's more of a long-term change. I think it's a wake-up call that you can't really be too reliant on one country if you're an exporter. So, over half of the businesses that do sell to the U.S. In our survey decreased the amount of business they're doing there. 14% of them actually have completely ceased selling into the U.S. I think part of that, obviously depends what you're selling and the tariff rate associated. But, it is a wake up call that you need to diversify. And, perhaps we'll see a change in the political climate, in the next few years in the US. But even so, another 4 years and it could change back. So you just need to be more diversified, and you can't be reliant on one, market as it relates to your exports.
Mhm. No, the reducing exposure to trade stocks is a necessary but a painful step in protecting a company's long-term resilience. So thank you for highlighting that, David. And to all the business owners that are watching, in 2026, loyalty to a single market, as David mentioned, is quite a risk that we cannot, as a market, afford. So if your supply chain or your sales are 100% dependent on the U.S., you're quite a passenger in a trade war that you cannot control. So now is the time to audit your margins, look for alternative sourcing before the next wave of tariff hits. Um, Next up, David, let's look at how companies are protecting their workforce despite mounting pressures. Does flat headcount show real resilience, or are layoffs simply being delayed?
So over the next 6 months, 59% of the businesses we surveyed say they expect their headcount to stay the same. The remaining 30 expect their headcount to increase. So generally speaking, businesses are not expecting to lay off in the near term. Having said that, in the last 12 months, 23% of the businesses we surveyed did lay off. So perhaps some of that has happened already and are feeling like they're going to try at least, to stick to their current level of headcount. Instead, they're looking at other ways to lower costs. 55% of the businesses we surveyed are planning to cut discretionary spending in the business. 45% are looking at additional financing. That's, of course, where businesses like merchant growth come in. And I mentioned earlier, obviously, the raising of prices and various things in terms of, adjusting how they manage their working capital in terms of what suppliers they work with and their inventory levels and things like that to try and optimize for better. Um, so generally speaking, as far as survey results go, businesses are expecting to keep their headcount steady. Is that a sign of resilience? Maybe I think it's a sign of commitment, to perhaps some optimism that they have adjusted sufficiently and have other ways to adjust, such that they can keep their current teams intact.
Absolutely. Now, choosing to cut inventory over staff, it shows how much small business owners value their team, even in a financial squeeze. Finally, David, let's explore how flexible financing helps businesses navigate uncertain markets. How does fast, flexible financing help businesses handle these sudden tariff shocks?
Access to capital is critical for a business. That is a true statement, regardless of what industry you're in and what size of business you run. Certainly, some industries are more capital intensive than others, but every business is subject to variation month to month, quarter to quarter, requires investments to grow or adjust. And so access to capital is critical for survival and for success. And the thing that we work really hard on at Merchant Growth is really making that access uh, broader, and in particular to smaller companies, which is where there's the biggest gap in terms of the financing need and what's available from traditional financial institutions. And yeah, so I mean, at the end of the day, you want optionality. Ideally, there's multiple different ways you can finance your business, and you can pick and choose what makes the most sense. If you're um, looking to make an investment that has high potential but high risk, that's more of the type of um, initiative that's better funded through equity, as opposed to a debt instrument where you have a prescribed payback to a lender on that. But many investments make sense to debt fund, right? If you make that investment in that expansion or piece of equipment or working capital, and you're gonna make a margin on that, make those sales, and be able to service the debt associated with making that, then it makes perfect sense to debt finance, right? So every situation is a little bit different. We solve the debt piece, of course, of merchant growth, but the more options small businesses have, the more they can adjust in changing times and ultimately thrive in the face of fierce competition from bigger companies.
Oh, this is very insightful, David. Thank you for that. And you're right. Having immediate access to working capital is the difference between a trade disruption being a minor setback or a business-ending event. This was a great conversation with you. Thank you for all that you were able to share in such a small amount of time. Um, as you wrap up, David, what is the single most important piece of advice for business owners that are facing trade uncertainty and shrinking margins?
Well, you mentioned a sec ago that access to capital is, could be make or break. It could be what allows a business to survive a difficult moment of disruption. Another thing about disruption, though, is it is an opportunistic moment, right? There's opportunities that come out of disruption. Um, and access to capital allows you to make the most of those. So whether that's buying a competitor's inventory at fire sale prices, or some other adjustments you can make that in normal times the price tag associated wouldn't make sense, but because of the disruption you can kind of make that work. And again, access to capital critical to not only survive those challenging times but make the most of them. And so my advice at this moment is, the job of an entrepreneur is to stay focused, have that kind of grit and resilience, and have a good dose of optimism that even when times are hard, there's opportunities in those times. And so, keep your eyes peeled for those and jump all over them when you see them would be my advice.
That is a great reminder that cash flow and adaptability, they are our best weapons in a trade war. Thank you so much, David, for your time and for sharing such great expertise and your insights with us.
No problem. Thanks so much for having me.
And listeners, that was David Jones from Merchant Growth, a vital look at how Canadian small businesses are navigating the toughest trade environments in decades. Thank you so much for tuning into the podcast. Please be sure to subscribe and visit CanadianSME.ca for more resources. Before we leave, a special shout out to our partners, UPS, Able Global College, Google, and EDP, for their ongoing commitment to empowering small businesses across Canada. Please keep thriving, and we'll see you in the next one.